Home improvement shares are on the rise. Bank of America Merrill Lynch's latest report says the gain in renovation spending is the first step in the housing recovery. A big part of the increase is also due to the increasing number of single-family distressed properties being converted into rentals. One of the authors of the report, Meyer, is senior U.S. economist at Bank of America Merrill Lynch Global Research, and she joins us from her office here in New York. Michelle, welcome to Bottom Line. Thanks so much for coming back on.
Thanks for having me on, Mark.
Michelle, we should note that you and the co-author of the report, Denise Chai, outlined three key areas: near-term macro upside, longer-term demographic support, and investor implications. Let's start with the near term. Is the housing market finally starting to heal?
There's signs of healing, and one of the areas where you're seeing some improvement is renovation spending, and that's the often overlooked part of the construction sector because historically it's a smaller share of construction and it tends to be a lot more steady. It doesn't usually exhibit the same type of cyclical patterns as new construction, but given the unique nature of this cycle, renovation spending is actually a bigger share of residential investment than new construction now, and we're starting to see some real good signs of improvement in the renovations market.
Well, you did mention that it is the often overlooked part, but how will it factor into a full-fledged housing recovery?
Well, I think what it does is it starts to put some use of the excess construction capacity to work. Some construction workers can find jobs as remodelers, as handymen. That's going to provide some income support. It's going to help building material suppliers. And more broadly, ultimately, it's going to go hand in hand with the gradual healing in the overall economy. When the economy starts to heal, we're going to see household formation return. We're going to see move-up buyers come back to the market. This is going to happen slowly, but we do think that it will be on an upward trend. That means that there's going to be more housing turnover. More housing turnover means more construction, which supports GDP growth.
Michelle, how much are home improvement stores like Home Depot and Lowe's benefiting from these renovation projects?
Well, that's where my colleague Denise Chai is quite the expert on. Has had a great call saying that she thinks that these stocks are going to very much benefit by the fundamental story for the renovation market. So we've already seen some upside. In her view, there's further to go.
Well, you also looked at what the report calls generational changeover in housing stock. And the research shows that those Americans aged 65 and older comprise the largest group of owner-occupiers. Are the elderly staying in their homes longer than historical norms?
Yes, we do think that's happening, and part of that is because people are living longer, they're working longer, they're staying put a bit longer than they have in the past. So that's really a structural trend. But also on top of that, we do think that the fact that we've seen such a big loss in home values, people are a bit more stuck in their properties. They don't have the ability to sell their family home and move into a rental and move into a smaller property with that cash flow and that savings. So it does mean that people are a bit more stuck. Ultimately, they will have to transition, and that's one of the demographic stories that we think will be quite strong in the next decade or so.
Well, I'm sorry, go ahead.
I was going to say there's near-term support because some of the side effects of this housing recession, converting distressed properties, the ultimate gain in household formation. But then there's longer-term demographic factors that means that this is going to be a continued trend.
Well, the last few years have seen a lot of homeowners fall on hard times. Job losses, flat wages, local tax increases, all of that's forced some homeowners to lose their homes and become renters. What age range are we talking about here?
The biggest demographic that's going to be driving what kind of new housing stock we are going to see are those that are going to be forming households. So 18 to 24 and 24 to 30 as well. And that's where we've seen a lot more doubling up than historically. And that's not sustainable. Ultimately, those individuals are going to want to move out of their parents' house, move out of living with friends, and form their own households. It's going to be initially more supportive for the rental market than for the ownership market, however, given that credit conditions are still tight and you need to have cash up front for a down payment.
Well, you talked about young people moving back home. Do we have a figure on that? How many young adults have been forced to move back in with mom and dad?
Well, if you look at and there's a chart in the report that shows that if you look at the 24 to 30 range. It's about 14% or so are still living with their families. That's up about 4 percentage points from the historical average. So it's a pretty big change relative to what we had seen prior to the crisis.
Michelle, we have less than a minute left. The report points out that the DIYs, the do-it-yourself projects, they're on the rise, and that a company like Masco Corp is a good barometer for home improvement demand. Among other things, Masco makes faucets and kitchen cabinets. What are Masco's bottom line numbers telling us?
Well, it's showing that you are seeing a pickup in do-it-yourself, and it makes a lot of sense because consumers are still cash-strapped, so they're going to spend kind of slowly in the beginning on maintenance, on certain types of repair. And the challenge with the increase in do-it-yourself numbers that we're seeing from the micro data is that it's harder for that to show up in the macro statistics. Yeah. It's much harder to capture the do-it-yourself projects than it is if they hire a big construction firm and you see payroll gains and you can capture that income generation.
All right, Michelle Meyer, senior U.S. economist, Bank of America, Merrill Lynch Global Research, joining us. Michelle, it's always a pleasure to have you on. Thanks so much.
Thank you, Mark.